All right, I'm live now. I've shared with everyone. I think now they can join in. Okay, let's continue now, friends. Okay, let me take my Zoom classes and let me share my screen. Okay. So friends, what I just taught you now is a very, very important concept, that value of any asset is nothing but it is the present value of future cash flows that the asset can generate. Keep yourself muted and repeat with me. Value of any asset is nothing but present value of future cash flows that the asset can generate. Value of any asset is nothing but present value of future cash flows that the asset can generate. Friends, this rule is applicable to the entire financial market. I can give you a few more examples to understand this better. Now tell me, who's your favorite actor or actress?
Kartik Aaryan.
Kartik Aaryan. Okay, tell me, how much money does Kartik Aaryan charge for a movie? How much money does he charge for a movie? Let's Google and check right away now.
Yes, sir.
How much? Kartik Aaryan charges for a movie. He's charging 21 crore rupees per movie. Okay. Now tell me any flop actor that you know. Any flop actor.
Ananya Pandit.
Who? Ananda? Is he some Kannada actor by any chance? Everybody? No?
No, sir.
Okay.
Actress, sir.
Actress.
Ananya Pandey.
Ananya Pandey. Oh, is it? Okay. Let us check how much. I don't know how many of you will debate on that. Okay, we'll discuss that later. For time being, let's assume that Ananya Pandey is a flop actress. So we'll just change the name Kartik Aaryan and put Ananya Pandey and check. 5 to 6 crore per film. Now, Kartik Aaryan is charging 21 crore. Ananya Pandey is charging 5 crore for a movie. I think I've got some more. Okay, Ananya Pandey is what you have written there, is it? Why is there a difference in the price? Why is there so much of difference in the price? One fellow 21 crore, other fellow 5 crore. Tell me some other actor. Some other, I think, supply demand. Okay, Yamini, one way.
Akshay Kumar.
Akshay
Arjun
Kumar.
Kapoor.
Akshay Kumar. Let's check Akshay Kumar also. So we'll come to know. Akshay Kumar. He's one of the top 10 highest paid actor. I don't know how much she's charging. That's not shown over here. But I think in Forbes, when you go, you'll come to know. He must be charging much beyond this. That's why it's coming as the top 10 paid actors. I have to go and subscribe and all. Ignore it. He must be charging somewhere more than this. Friends, Prabhas, for this movie, Adi Purush, he charged 150 crores. One movie. But that movie became a super flop. So for the next movie, his price came down to 50-60 crore. Friends, in simple terms, why is Kartik Aaryan able to charge 21 crore is because value of Kartik Aaryan depends upon how many people go and watch his movie. If he is a super celebrity, more people will watch. When more people watch, more cash flow will be generated. So value of Kartik Aaryan is nothing but present value of future cash flow that Kartik Aaryan can generate. Ananya Pandey is not able to generate so much of crowd, so that is why she's able to demand only how much money per this thing? Only 5 crore rupees. Value of any asset is nothing but present value of future cash flows that any asset can generate. Now let's go to corporate examples. Zomato. What is the value of Zomato? Any idea? It is $11 billion. Okay. Swiggy is also somewhere around, it's around $12 billion. That's because it's created a hype right now because of the IPO and things going on like that. There was another company, Byju's app. Heard of this? 6 months back, it had a valuation of $22 billion. Today, the valuation has crashed down to less than $1 billion. Why? Zomato, surprisingly, is running at a loss, huge loss. Swiggy is also running at a huge loss. Some 1,500 crore is the loss, approximate loss of Zomato. Even after having this kind of loss, why Zomato is having a valuation of $11 billion is because Zomato has right now captured 12% of the market app users. What is meant by 12% is that if 100 people are using Android or iPhone, out of these 100 people, 12 people have installed the Zomato app and they are actively using Zomato app. Okay. So the calculation is that this 12 people or 12 percentage are using the app right now. The moment it goes up to 22 percentage, the revenue will become double. Expenditure will remain the same. That time they will make huge profit. Huge profit means they will have a high valuation. So value of Zomato is also nothing but present value of future cash flows that Zomato can generate. Facebook had acquired WhatsApp. When Facebook acquired WhatsApp, the valuation of WhatsApp was done based on number of active users of WhatsApp. Okay. So at that time, I think they had some 10 million or some number of users were there, some billion users were there. They multiplied that if one user is giving $1, they will get $10 billion. Then this will keep on increasing. That is how Facebook acquired WhatsApp, because valuation of WhatsApp is also nothing but present value of future cash flows, what WhatsApp can generate. Friends, why I'm spending so much time here is because this concept is going to be applied by you from today till the last day of my class. In fact, my entire class will be only about one thing. Value is nothing but present value of future cash flows. Can you just scribble and write down all this in your books? Write down in your own language so that you understand the concept clearly. YouTube students, I believe you are all comfortable. I'll check that in my phone.
Sir,
Yes.
how do they even consider the number of years for valuation?
They take it towards perpetuity. I'm sorry, who's speaking with me?
Divya.
Divya, I think I've told this earlier also. It's a perpetual cash flow, right? These companies are having a going concern, right? So when you say a going concern, it will go on forever. So we take a perpetual cash flow. That I'll teach you next. Perpetuity is the next concept that we will learn, slowly. All right. Are you all done writing this in your books now, friends? Perfect. Okay. Fine. So let me go to the next part now. So I think you're all clear with the valuation concept, that value is nothing but present value of future cash flows. Okay. Now we will learn the next one concept, which you have learned in your inter-level. Concept heading will be IRR. What is the full form of IRR? Internal
Rate of return.
rate of return. Okay. Now tell me, what do you mean by IRR? It is the rate at which NPV becomes zero. IRR is the rate at which NPV becomes zero. So what I will do is I'll give you simple examples to understand first. Example number 1. Year, cash flow, discount factor, discounted cash flow. Suppose year 0 you are investing 100. Year 1 you are getting 120. Can you write down this, use your common sense, and tell me what will be your IRR in this case?
So 12%.
12%? No, the answer is incorrect.
It comes to approximately 99.99 minus 100, which is equal to 0.
At 12%, is it? Okay, hold on. Have I taught you how to use the discount factor using calculator? Do you know that?
Yes, sir.
Wait. Just for my satisfaction, I will just explain to you how to use the calculator. Okay. So wait. I'm just giving you a heading over here. How to use. Everyone might not be knowing. Calculator to find PV factor. Okay. Now let's say I want to take a PV factor for 10%. What you should do in the calculator is press 1. I want to do for 10%. Let us say 5th year. So take your calculator, friends. And okay, I'm just watching you. Let me know if you are facing any difficulties. What you should do is different calculators work in different ways. So I'll give you different hacks for different calculator. Okay. So normally the best method will be you do 1 divided by 1.10, 1 divided by 1.10. Rutvik, Vijay, your answer is right. I'll come back to you. Okay. After doing this, you have to press equal to 5 times. Press equal to 5 times. 1 divided by 1.1. Press equal to 5 times. Do you get the answer as 0.620?
Yes, sir.
Yes. Okay. Most of the calculators will work this way, but all calculators don't work this way. Okay. Anybody whose calculator is not working this way, just raise your hands or tell, or just message no. Everyone is comfortable with this method. Okay. If some calculators don't work this way, there is another method. Abhijit, not working for you, right? Abhijit, what you do is you should press 1 divided by 1.1. Then you press into. Then you press equal to 4 times, because when you do into already one PV factor would have already come in. Just try that way now. Kanisha, you also try in this way and let me know whether you are getting the answer. Kanisha, did you get? Yeah, perfect. Perfect. What about you, Abhijit? Did you get? Fantastic. So I hope you are clear with how to take the PV factor using this calculator. This is for normal. Now I will tell you how to do annuity factor. Okay. So for annuity factor, let's say I want to take the same 10% for 5 years. Method 1 will be 1 divided by 1.1. Press equal to 5 times and then press GT. Try like this. Not go to GT. Did it work for you? If it worked, tell me yes. If otherwise, tell me no. 3.79 is the answer. Correct. Fantastic. Okay. For those of you it did not work, one other method is there. Method number 2 is 1 divided by 1.10. Press equal to memory plus like this you do 5 times. And then you press memory recall. Try it like this. Okay. If you still didn't get after this, please message me personally. I will guide you. Okay. Right. Perfect, friends. So I think we are all through with this part also. Now, when you do like this over here, the answer is not 12%. The answer will be 20% because here it will be 1.000. You should get the answer over here as 0.401 if I'm not wrong. Okay. So 120 into 0.401. No, sorry. Multiplied by 45. Sorry, year 1 itself. Right. Sorry. 0.833 will come over here. So your answer will turn out to be minus 100 plus 100 and your NPV becomes 0. Okay. Perfect. Are you clear with example number 1 now, friends? Wait, let everyone finish writing.
Sir, I did not understand how did we get the 20%, sir?
I actually used a common sense over here. In reality, this is not how you will do. What I did was, listen over here carefully. What is the investment? I'm sorry, who was speaking with me?
It's me, sir, Akhila.
Akhila, how much is the investment over here?
Minus 100,
Okay, how much is the returns I get in the end of 1 year?
120.
120. So I am getting a 20% return.
Yes, sir.
That is my IRR. IRR is nothing but my actual return on investment.
Okay.
So when you put 20% over here, by default, your NPV becomes 0.
Okay. What is the actual percentage of increase? If we just use that as a discounting factor, then the total will become 0.
Fantastic. Okay, now this was a very basic and an easy question. Exam questions will not come like this, but that's where I will teach you how to go about. Okay.
Okay, sir. Thank you.
Okay. Example 1, everybody clear? I'll now give you example number 2. Year, cash flow, discount factor, discounted cash flow. Year 0, 100, year 1, 130. Come on, use your common sense and tell me what is going to be your IRR. Now I think your common sense have told you the answer. What's the answer you get over here? Do you get the answer as 30%? These are all logical questions. I'll go to advanced level after you understand the logical question. Minus 100 plus 100, your NPV will become 0. I will now give you example number 3, friends. Are you ready? Example number 3. Year, cash flow, discount factor, discounted cash flow. Year 0, 90. Year 1, you are getting 108. Come on, tell me the answer on your own now. Fantastic. Did you get the answer as 20%? That is the ROI. You will get 1 over here, 0.833. So minus 90 plus 90, NPV becomes 0. Are you all clear so far? Okay. Now I will give you a little bit more complicated question. I just wanted you to be clear on the basics part. Is everybody clear with the basics part now, friends? All of you? Yeah? Sneha, are you clear? Yeah? All right. Okay, I think others are clear. Okay. Now I will go to an advanced part. Okay. Now suppose the example number 4. The question comes like this. You have year, cash flow, discount factor, discounted cash flow. Year 0, 100. Year 1 you get 20. Year 2 you get 60. Year 3 you get 100. Now we have to find out what is the IRR. So this is difficult. Earlier question, it was very easy. 100 year 0, year 1 number was easy. But here you have 3-year different cash flows. So that actually becomes very difficult. All right. So at this point, what we'll do is we will take a guess rate. For example, I will take the first guess rate as 10%. Then I will take a guess rate as 20%. So there is a gap of how much? 10% over here. Okay. Can you please put this? Tell me what is the NPV you get at 10% and what is the NPV you get at 20%? Can you tell me? $42.84. Is it plus Berlin? Okay, so you get plus 42.87. And how much do you get at 20%? Also, you get plus only 16.2 plus is what you get?
16.1.
Plus, right?
Yes, sir.
Okay, we need to have a negative NPV. So please put 30% also and do it now. You get plus 8.8. My God, what number have I taken? Wait. Berlin, you get minus 306. That's impossible. Minus 3%. How did Rutvik get plus 8.8? I think it is minus 3.6.
Sir, minus 3.6.
Fantastic. So friends, if we want to take an IRR, we should have one positive NPV and the other one should be negative NPV. In between these two lies the NPV of 0. So to get this 0, we do something called as interpolation. So I will write down the next heading over here. Interpolation. Okay. I will slow down, friends. Don't worry. Let me just finish writing this. I'll give you time to write down. So now here what I'm going to do is I'll draw a chart like this. We have 10, sorry, not 10. I think we have 20 and we have 30. At 20%, you get 16.1. At 30%, you have minus 3.6. I am looking for an NPV of 0. So from here to here, the distance traveled is 16.1. From here till here, the distance traveled is 16.1 along with 3.6. Total will become 19.7. Whereas from here to here is what we have to just find out the distance. If we get this distance, I will be able to find out this rate. So ultimate objective is to find out what will be the rate over here, for which we will use interpolation, and the equation will be 20% plus 16.1 is the distance traveled. Overall distance is 19.7 multiplied with a gap of 10%. So I'll get the answer as 28.17%. Can you please slowly write down this in your books? I will slow down. Friends, are you all clear with this? I'm just slowing down a little bit so that you all can be thoroughly clear here. Binsi, okay, I will repeat. Binsi, can you unmute and speak to me so I can one-to-one explain to you the whole thing?
So,
Yeah.
so can you please repeat once again
You
that
want me to explain this
20
part,
to
right?
0?
Which one?
20 to 0, the 20% to
Okay.
0,
I will
16
explain that to you. Okay, see, Binsi, listen very carefully. Here at 20%, my NPV is plus 16.
Yes,
At 30%, my NPV is minus 3.6.
yes.
So somewhere in between, my NPV is 0.
Hmm.
To get this NPV, I should take the, from here to here, the distance traveled is this much, right?
Yes.
This is equal to 16.1.
Okay.
But from here to here, the distance traveled is 19.7.
Okay.
I want to take the proportion of 16.1, which we have to 19.7.
Hmm.
So when I take that proportion, how much is 16.1 divided by 19.7 in percentage terms? It is 81%, approximately 82%.
Hmm.
That, what is the logic of that is that 82% cash flows are accruing here, remaining 18% of cash flows accrue over here.
Hmm.
Okay. So basically what happens is from here to here, the total gap is how much percentage? 10%, right?
Yes.
So this 10% is the total distance, but I want only 82% of 10%.
Correct.
So 82 of 10 is 8.2.
Hmm.
That 8.2, if I add with 20, I get the answer over here as 28.20%. That's what I got over here.
Okay. Clear.
This is what we call it as interpolation. Vishnuta, please speak to me.
Sir, how did we get that 19.70? I did not get that.
19.7.
The
Okay, that
entire
is basically,
distance.
this is 16.1 positive minus 3.6 will give you plus 3.6, right?
Okay, okay.
Clear now?
Yes, sir. Yes, sir.
So
Got it.
it's 16.1 plus 3.6. Okay. IRR being a complex topic, I'm going to give you 2 more questions which you have to solve it on your own here itself. Conceptual clarity is very, very important for me. I will take it very slow and very steady. Fine, friends. I hope you're all clear with this part now. I think Binsi is still writing. Let her finish. I believe others are done. Okay. Can I give you the next question? Can you try doing it yourself?
Yes.
Are you ready?
Yes, sir.
Okay. You only tell me some numbers. Year 0, what should be the cash flow? Anyone unmute and tell me whatever number comes to your head.
200.
90.
No 100,
90.
some other number.
99.
90?
96. 96.
Fantastic. Year 1, 2, 3. 3 years are there. Year 1, how much?
47.
47. Fantastic. Year 2,
54.
54. Fantastic. Year 3,
65.
all the best. Do it now. Let me see who gives me the answer first. Friends, please don't use Excel and give me the answer, okay? No cheating. Somebody has sent me a message. Nadeem, 31%. Shiva says 29. Rutvik, 31. Great speed. Let others also confirm that this is the right answer. 31.195, Srihari, Lipika, Aditi, Achyut, great speed. All right, can we try doing it ourselves, friends? Can I just give you the hint of how to do it? Okay, I'll just give you the answer. Many are still doing, let them do it. So basically, you would have taken data from 30% to 40%. Am I right?
Yes,
Okay, at 30%, what is the NPV that you get?
1.685,
Okay, and what about in 40% minus
11.244.
11.245? So from here to here, the total gap would be
12.9.
12.93. Whereas from here to here will be 1.685. So the formula would be 30% plus 1.685 divided by 12.93 into 10. Okay. Let everyone finish doing this, friends. Perfect, friends. Are you all now clear with the concept of IRR? Or do you want one more question?
One more.
One more question? Fantastic. Ready? Okay. Tell me, what will be your year zero cash flow?
Sir, I have one doubt, sir.
Tell me, tell me.
Sir, is it into 10 or is it into 10%?
10%. Everything is in percentage, right? So even this is 30%.
Okay.
Even this is 10%.
Okay.
You take it as whole numbers and do it. Whatever answer you get, you give it in percentage.
Okay. Okay.
All right.
Yes, sir. Thank you.
Aditi, you can take 35 instead of 40. Nothing wrong. If you take 35, you have to do into 5. That's all. Okay. Perfect. I think you're all clear with this part. Okay. Let's do the final question. Tell me, year zero, how much should be your cash flow now?
84.
10% resembles the difference.
84.
Okay. 84. Fantastic. Year one.
28.
28. Year two.
39.
Year three.
53.
Do it. All the best. Achyut has got 19%. Good speed, Achyut. Let others also confirm. Deepika, you got 18%. Okay, I think it's almost similar to 19. So I think answer is correct. $18.52. Little bit of deviation everywhere. That's okay. That's all rounding off error. 19.37. 18.09. I think anywhere from 18.5 to 19.5 is approximately correct, is what I believe now. Okay. 18.08. Fantastic. 18.2, 18.19. So here, can you tell me? So you would have taken the guess rate as 10% and 20%. Am I right? At 10%, can you tell me what was the NPV that you got over here?
13.5.
13.51.
How much?
13.5.
13.51.
And how much at 20%?
Negative 2.91.
We are looking at the midpoint where the NPV is 0. Okay, so from here to here, it will be 16.42. And here 13.51. So it will be 10% plus 13.51 divided by 16.42. That's 10.82%. Sorry, into 10. You'll get 18.20%. Okay, fantastic. I believe everybody is clear with this part now, friend. Are you all clear with the concept of IRR? Okay, this also I went in elaborate manner because of one reason. First, you write down what are the steps in calculating IRR. Step number 1 is calculate initial guess rate. So you would have struggled in this. You would have taken some guess rate and then you would have done it. At CA final level, you do this using YTM formula. Okay. What is YTM? I'll teach you in the next chapter. Okay. After that, we take second guess rate. So second guess rate, you can take either +5, +10, or I think if you take YTM, even a guess rate gap of 1% will give you the answer. So it will be initial guess rate plus you can maybe put a 5% gap. Okay. After that, we'll go to step number 3 where you call it as interpolation. Please write down this in your books now. Friends, are you all comfortable?
Yes, sir.
Okay, so I believe all of you are done writing this in your books? Okay. Can I go to the next part? All right. So we are done with the steps of IRR. Now I'll write down the next concept heading. In the long run, IRR and discount factor will be the same. We will go back to the example of that Wagoner. Now tell me, my dear friends, in the example of Wagoner, what was the price of the car eventually?
10 lakh.
10 lakh was the price
Zero
after
nine,
purchase.
zero
What was
nine.
the eventual price of the car?
909,909.
Was it 9,09,091? Correct. So basically, if I buy the car in year 0, I will have to pay 9,09,091. Correct. Year 1, I will get the car for 10 lakhs. My discounting factor was 10%. Correct. Year 1.909. So 9,09,091. 9,09,091. My NPV becomes 0. Or NPV becomes 0 means it's the rate at which your NPV becomes 0. Or can I say in the long run, price of car will move in such a way that discount factor and IRR will become the same. Can you write down this in your books? Chinmay, you are making me hungry.
Sorry, sir.
You can eat that Maggi noodles will become cold. Abhijit, you have a very good point. Up to what decimal we have to take? 2 decimals is enough, Abhijit. You will never lose marks because of decimals. You will lose marks because of conceptual misclarity. All right, friends. I believe all of you are done writing this also in your books. Can I go to the next part now? I think some are still writing. Let them finish. Friends, if anybody is not done, just type ND and let me know, okay? I'll put all this in a notes folder and share the notes also with you so you can get the updated notes, handwritten notes on your own. Okay. So I think all of you are done writing this. Let me go to the next part. Okay. Now, write down the next concept heading in your books. Relationship between cost of capital and discount factor. In your inter FM, you had a chapter called as cost of capital. There, we have learned the word discount factor is nothing but investors' expectation. In your inter FM, you have learned multiple words: KE, KD, KP, WACC. And there is one more word called as yield that you learn at the final level. Okay. Now interact with me. Discount factor is investor's expectation. What do you mean by the word KE?
Cost of
Cost of
equity.
So cost of equity is for whom? It is for equity holders, correct? Or it is actually nothing but equity holders' expectation. What about KD?
Debenture holders.
Rate of return expected by debenture.
Debt holder.
Debt holders' expectation. What about KP?
Preference shareholders expectation.
Fantastic. WACC will be
Weighted average
overall
cost of
investor
equity.
expectation. Yield is bond. What is bond? I'll teach you in the next chapter. Bond holders. Friends, all these are nothing but investors' expectation. The only problem is investor is different in each scenario. Are you clear with this part now? Okay. So if this part is clear to all of you, what I'm trying to tell you over here is that discount factor and all these things are the same. Only thing is investors are different. So discount factor is equal to KE is equal to KD is equal to WACC is equal to KP. Only investors are different. And in the last concept I taught you, in the long run, discount factor is equal to what?
IRR.
IRR. In the long run, discount factor is equal to IRR means here what will I tell? In the long run, IRR is equal to discount factor is equal to KE is equal to KP is equal to WACC is equal to yield. Everything NPV will become 0. Please write down. Vishruta, you have a doubt?
Yes, sir.
Yeah, you can directly speak up. You don't have to raise your hands. I might not
Okay.
see that. Okay.
Yes, sir. Sir, I have a doubt in that IRR, percentage selecting. So, what percentage is ideal to select? Like some place it is 30 to 40. 30 we took, then 40 we took. Some place directly 10 and 20. Some place 20 and 30. How will we know which is the first percentage to take?
That we'll do it using YTM formula. That's what I gave you in writing here.
Okay, sir.
So this you will understand next chapter. I will show you this also. Okay.
Okay.
YTM is nothing but you have learned this in your inter FM with the name of
Yield
approximate.
to mark.
When you
Yield
do
to mark.
KP, redeemable preference shares and redeemable debt, we had a formula, right? Dividend plus redemption value minus issue price divided by life. That whole formula will come over here. All right. Yeah.
Sir, is it
Thank
the
you, sir.
same in which we took the first year as 0, second year the amount of interest, and the third year total yield redemption value?
Exactly. I will be explaining all that in the next chapter. Okay.
Yes.
All right, friends. Are you all done writing this in your books? Yes. So friends, with this concept, we are done with the basics part. Okay. Are you all thoroughly clear with the basics part? Can we recall the entire basics from the beginning once again now? Okay.
Yes.
So I'm just removing the camera. Keep your cameras on and keep yourself muted. I want to see you and I want to see you lip read. Okay, ready? Fine. Everyone interact with me. What is the full form of NPV? Net present value. All right. Net NPV is nothing but it is the present value of cash inflow minus the present value of cash outflow. Then we learned about cash flow. How do you find out cash flow? It is PAT plus depreciation minus capex minus additional working capital. Then today I taught you how to take capex. How do you take capex, friends? Capex is nothing but you take the assets of 2023 and assets of 2024 and you take the difference over there. Are you getting my point? Okay. Wait, I think there was a doubt. Abhin, I'll come back to your doubt. I'm reading a message now. I'll come back to your doubt. Okay. Fine. Next one. Additional working capital will be nothing but working capital of 2024 minus working capital of 2023. This is how we do it practically. And I will show you this when we do the chapter of business valuation. Everybody clear? Next thing. After we are done with this part, then we learned about discount factor. Discount factor is nothing but investors' expectation. Then I told you KE is nothing but equity holders' expectation. KD is nothing but debt holders' expectation. KP is nothing but preference holders' expectation. WAC is nothing but overall investors' expectation. In the long run, all these are nothing but the IRR. IRR is the rate at which NPV becomes 0. What are the 3 steps in IRR? Step number 1, initial guess rate. That you do it using the YTM formula. Step number 2 is what? Second guess rate. And then what do you do? Interpolation. Everybody clear with this part? Then we learned a very, very important concept. Value of any asset is nothing but present value of future cash flows that the asset can actually generate. Value of an asset is nothing but present value of future cash flows that the asset can generate. Is everybody clear with this part now?
Yes, sir.
Okay, fantastic. So friends, we are done with the basics part. Now we have to go into the advanced part of the chapter where we have to start with the chapter called as bond valuation. Friends, even before I go for this chapter of bond valuation, I just want you to install my app and I want to show you how I will be giving you access for the mastery book. Okay, 1 minute. Do you have your phones with you?
Yes.
Okay. Please, if you have your phone, I'll just write down and show you. You may be using either an Android phone or you may be using an iPhone. I'll just give you the categorization. If you are using an Android phone, please go to Play Store. Okay. And after that, you install an app called as Tarun Jagdish. If you are using iPhone, you go to the App Store and you have to install an app which is called as Class Plus. Once you install this, they will ask you for an ORG code. Here you give the name as ELEVM.
So can we do it in laptop?
You can do it in laptop, but books will not be available. If you are using laptop, the ebook of mastery book will be available only in the tablet or phone. Okay. In laptop, you can use the link as class.tarunjagdish.com. To do it now, I can parallelly see. Okay, wait, I think I have lost my access to Class Plus. My dear friends, I am myself logged out of Class Plus. Okay, you please install the app. I will add you in the coming batch. Okay. First, I need to get access. Only then I can give you access on that. Okay.
Can you show the code, please?
Code, yes. 1 minute. 1 minute.
Yearly.
Are you able to install the app, friends? If you're facing any difficulty, let me know. Done? Okay. Now, since I have myself lost the access, I will not be able to add you today. I will tell you what are the contents that will be available in the app so that you understand how to use this. Okay. Inside this, there are two parts. One is called as the batch. Other one is called as the store. Okay. In batches, I will be adding you to the first batch, which is the mastery book batch. The moment I add you over here, you will be getting the free ebook. Everybody clear? That is the first thing. Second, there will be a batch which is called as AFM Success Series. The moment you enter this, you will be getting, revision of the entire AFM in 10 hours. That's not applicable to you now, but once my class gets over, if you want to revise almost all the important concepts in less time, you can do it using AFM Success. Okay. These are the two things. And third, my mentoring is going to happen in my batch. That is my mock exam and MCQs will happen in the batch. Store is more of a paid content. So all the classes that you're attending right now, that is today's class, last day's class, the recordings of all this class will be available to you in store. Point number one. All right. Apart from that, we have some, important content like Super 50 is there, where I have cracked some of the best 50 questions. Super 25 is there. They are all available for 99 rupees. You don't need to buy them because we are covering everything. But in the end, suppose you want to just, do the best 50 questions, you can just go and purchase the Super 50 from their store. That will be 99 rupees. Why 99 is because we cannot offer things free of cost in store. Some money has to be charged. So it's not something that's, for taking profit, but just to make the app usage convenient. That's all. Okay. So I think next class, I will add you to the mastery book and you will be able to access the free ebook from Sunday onwards. All right. Or if possible, I'll try doing it today and update you in the group itself so that you all can join. So there will be a batch code. I don't remember the batch code. If I'm not wrong, it should be AFM mastery, but I don't remember it now. So let me double check that and I'll get back to you on that. All right. Anybody facing difficulty in installing the app? Yeah, I mean that batch code I will tell you in the next class. I myself don't remember. I will tell you in the next batch. Okay.
So
I mean
does
your
it
doubt.
look like this?
Tell again, come again. Binsi, come again.
Sir, does this look like this here, the app piece? It is your, I think, CA Tarun Jagdish, it says.
That is me only.
Mm.
That's my app only. Okay.
Yes, okay. Thank you.
So is that discounting factor and return become equal? What is the benefit for the investor? Ebin, can you unmute and speak to me?
Yes, sir.
Ebin, you have asked a very, very good question. If the return and IRR becomes the same, what is the motivation for the investor? In reality, that will never become
Yes,
same.
sir.
In reality, that will never become same because that's the reason prices keep on fluctuating. Are you getting my point? Okay. But always that
Yes, sir.
effort is to touch the equilibrium price. Even Wagoner, if the price is 9,09,000 today, tomorrow it will be 9,12,000. It keeps on changing. There will be fluctuation always. Okay. Because future cash flows will keep on changing every now and then. Am I right? Okay. Right. But theoretically, it should reach that equilibrium price. All right. Yes, friends. Okay.
Yes.
So friends, I don't want to overload you in the initial 1 or 2 days. Are you all comfortable with what and all was taken today, friends?
Yes, sir.
Sir.
Yes. Fantastic. Okay. Now, today is Friday, so we had one session on Wednesday. Today, one on Friday. Next, tomorrow there is no class. Sunday onwards, our classes are going to go in full swing. So, if some of you have not registered, please do register because today I couldn't go only for the premium students, mainly because some registrations was pending. So, if anything is pending, please do it. From Sunday onwards, full-fledged class. Ebook of Mastery Book will be given to all of you. ODB already the books have reached Kochi office. From there, the courier will start going from tomorrow onwards. But that will go to only registered students. So I believe you have already given your address and everything to the team members. So you will get the hard copy of the ODB book, which you can use it for problem solving purpose in the class. Everybody clear with this part? All right. And one more thing, friends, I got messages from a few students who are from Karnataka and Tamil Nadu. Due to articleship, many are unable to reach back home by 8 o'clock. So they were requesting that I keep my class from 8:30 to 10:30. What is more convenient, friend? 8 to 10 or 8:30 to 10:30?
8 to 10, sir, please.
Yes, sir.
Just put in the chat box. Initially, I have committed 8 to 10, but if majority wants 8:30 to 10:30, I can change it. Hold on. For every 5, 8 to 10, one is coming with 8:30 to 10:30, is it? Okay, for time being, let us not switch the timings. All right, let's keep it this way itself. We will then decide once again and we'll see. Okay, because 10 o'clock the class will get over. So if some students, if you are unable to, attend the class at 8 to 10, recordings will be uploaded by 11 p.m. in the app. From Sunday onwards, you will be getting seamless access to the classes. 10 o'clock the class gets over. By 11, I will upload the entire content into the app. So suppose if anybody is reaching late, for you, we will provide the access. You can start watching a little later at night, or you can just watch with 1 day in areas. Okay. Maximum try not to miss the classes. I want all of you to attend. That's why I suggested 8:30 to 10:30. But since majority are comfortable with 8 to 10, I don't think it will be good enough for me to change the time after announcing it. Okay. So let's stick to 8 to 10. Please try your best to attend the class in 8 to 10. If you're traveling, you can put headphones, sit and you can attend the class. All right. But please try not missing it. Sorry for the trouble for all of those who are traveling in the evening. Okay. Yes. Any other doubts? Evan, you had some doubt? No, right?
No, sir.
Okay, fine. So friends, Wednesday and Friday, 2 days, we did the basics. Sunday, the proper class will start. Security valuation. Inside that, we have bond valuation, share valuation. So we are going to start with bond valuation, a very important chapter for your examination. At least 8 to 10 marks question always comes in the examination. Okay, friends. So I'll see you on Sunday evening at 8 o'clock. Have a nice time ahead, friends. Take care. Thank you.
Thank you,
Thank
sir.
you.
Thank you so
Thank you,
much.
sir.
Thank you, sir.
Bye.
Thank you, sir.
You.
Thank you, sir. Thank you.
Thank you.